Greetings traders and welcome to Exness Talks, your go-to source for the latest analysis and ideas from markets, plus tips for trading and more. Hello traders and welcome to the latest analytical podcast from Exness Talks. And joining us once again, we have Stanislav Bernikov. Thank you very much, Stan, for joining us for this podcast.
Hello everyone, thank you Michael for having me today.
And the first question that's on many traders' minds today is, what's going on with crypto? We've seen quite a big change in terms of sentiment on crypto markets over the weekend. Do you think that this is the main factor behind the latest losses? And do you think there's any instruments that might stand to gain from crypto's losses? How generally do you view the latest events in crypto markets?
Yeah, interestingly enough, so we see the Bitcoin going down for more than 10% overnight. And why did that happen? Actually, some people say that it was due to the Elon Musk's tweets, because he had said that Tesla would not accept Bitcoins as a payment for the new cars. Some people say that it was happening due to some technical reasons. Actually, we were pointing out this opportunity maybe several weeks ago when Bitcoin was at the top of 64,000. Well, not mentioning that, I remember this tweet. Not that kind of stuff, but the Bitcoin is in a mature trend, or has been in a mature trend, going higher, testing new highs, and that's very explainable in terms of supply and demand. So when we see the instrument losing momentum, like Bitcoin did maybe a month ago, it's not unusual to see it going down when it has some negative comment of the influencer like Elon Musk or anything else. So people start dumping Bitcoin actually, and it's going down. So nobody accumulates that just yet. So that's very logical. That fits into the technical picture. So I think that the long-term view still sustains as bullish for Bitcoin, but nobody knows where the low would be in this case. So we might take some arbitrary levels like 35,000 or 30,000 or maybe 40,000. So nobody knows exactly when the low is going to be. But usually the sentiment is obviously changing. So it's negative at the moment. So at least some investors or some traders will start getting rid of their Bitcoins. And particularly in this institutional money may start changing their allocations in such assets like Bitcoin, gold, and other assets which protect against inflation. Because inflation actually is the big deal. We'll talk about that later in the podcast. But Bitcoin was an inflation protection asset. But now it looks as the volatility is very high, so it makes sense to keep cash in gold rather than in Bitcoin. So we see the rise in gold, as you see for the previous week, and the plummet in Bitcoin. So we obviously see this rotation between assets. So gold is becoming more popular. It was not popular at all a month ago. Bitcoin was at the peak of the popularity. Now the situation is changing. So I would rather be in gold rather than for Bitcoin. And possibly some institutional money also thinks so too. At least we see that on the graphs.
And one of the catalysts as well for this movement into gold is inflation data from the USA last week. Since inflation has now been shown to be higher than expected, seems to be another quite important factor in favor of gold. And you think possibly it could be important for other commodities as well.
Yeah, that's very ambiguous factor. So previous month or maybe 2 months ago, gold was acting quite oppositely, reacting on the inflation in the opposite way. So inflation was going up, so treasury yields were going up, gold was going down, because there was there was an expectation that treasury yields are going up, so treasury bonds will become more popular, and the gold was going down. Now, as the treasury yields are stable, but inflation is going up, so gold is becoming more popular. We need to understand this context. So it doesn't work every time with the same manner. So every time market is appreciating assets differently. So now we see that treasury yields are not growing, so treasury bonds don't make sense for investors. Gold makes sense, and crypto doesn't make sense because it goes down, right? The gold is a winner in this situation. And now it gets back in focus as an inflation protective asset. and we should also treat it as this kind of asset too. So, from the supply and demand standpoint, we've seen that the gold was accumulated by the latest numbers from commercial traders. And actually, they were accumulating gold more and more and more. And finally, we see the reversal, the intermediate term low. And so that's kind of logical. We never know when exactly the rise is going to be, but when the supply and demand factors fit in some, at some point in time, so finally the instrument goes up. That's what we see for gold.
Mm-hmm. And finally, do you think you could give us just a quick summary of the latest factors for indices and some of the factors that might be affecting indices moving forward? Since we noticed that there were losses for the NASDAQ to some extent last week, from which it's actually recovered relatively strongly over the last, on Friday, basically.
So stocks, US stocks particularly, they are kind of influenced by two narratives. The first is inflation, right? It's the main narrative, which actually is widely discussed in the community, in the investment community. Some people think that inflation will not continue going higher because it's the kind of low base effect and something like that. Some people will anticipate the further rise of inflation, which will boost the expectations of rising interest rates in the future. And that's one narrative, which is negative for stocks. And another narrative, which is positive for stocks, is economic recovery, actually. And recovery is doing good. So we see these two factors balancing and influencing stock indices. So at the first hand, we see inflation. On the other hand, we see economic recovery. So what will take control? We don't know. So I would personally think that it might be a better option to hold stocks which would benefit from this economic recovery, but will not be exposed to inflation. Something like financial stocks, industry stocks, restaurants, and stocks like that, which has low PE ratio, price earnings ratio. Those inflated stocks like technological stocks might suffer from the inflation, actually. So they might go down as a response to the rising inflation. So I would still think that the broad market will be relatively stable, like S&P 500. But within this S&P 500 index, we might see that the driving force is going to be not technological stocks, but possibly the stocks with the lower PE ratios. Finance, industry, restaurants, maybe airlines, why not? So because the world is opening, and similar stocks. Those stocks like technological and growth stocks like Zoom, Twilio, Baidu, Tesla, all those stocks which were very, very profitable so far, that they are no longer in the focus of investors. For example, this ETF, the hedge fund called ARKK, driven by Katie Woods. This is a superstar from in the hedge fund industry. So her hedge fund had lost maybe around 40% from the peak. The main holdings in this hedge fund is Tesla, Zoom, Twilio, and stocks like that. So, of course, how do you think? The investors are feeling so much pain when they see that. And they will try to relocate their portfolios. They will try to get rid of those names. So if I would hold stocks right now, I would focus on some stocks like Bank of America, Goldman Sachs, things like that, and Boeing and other airlines. So that's at least what I would expect. So two narratives, inflation and economic recovery. So that means that the broad market is going to be, I think, stable, relatively stable, but we need to figure out what will affect, what sectors will be affected positively from the economic recovery and what not.